to the Smart Property Investment Show with your host, Phil Tarrant. This podcast is brought to you by Defence Housing Australia. Invest in a Defence Housing Australia property and they'll pay your rent, manage your tenants, and even take care of day-to-day maintenance. Rental income is guaranteed for up to 12 years. Your rent is reviewed annually to market value and will never fall below the starting rent. So all you have to do is sit back today and look forward to tomorrow. To find out more, call 133 DHA. That's 133 342. Or visit dha.gov.au/lookforward.
Welcome to the show. Phil Tarrant here. I'm joined by two people today. I've got Alex Whitlock, who heads up publishing here at Sterling Publishing. And I'm also joined by special guest Charles Tarby, who is from Century 21. Welcome, guys. Thanks for coming along.
Hi, Phil. How you doing?
Really well. Charles, let's have a chat about just your experience as a property investor. So I know you've been in the real estate game for quite some time as an agent and then as the head of Century 21. But I want to get into your property portfolio and let's have a chat about that. Can you tell us a little bit about your first property?
I can. It's a very, very diverse property portfolio, not always for the right reasons. I'll explain that in a second. My first home I bought, I was 18 years of age, strangely enough, saved up $50 a week. I used to catch a train to my real estate auction role in the city of Sydney and just kept putting away $50, never did much with it. And then a year later I bought a property in Punchbowl, of all places. And in those days, when an agent would say to you it's close to public transport, a stone's throw, you know, the usual thing, it meant it was on the highway. And this one certainly was. It was on a very busy road facing the railway line. But like all real estate cycles, they don't grow at 4 or 5% every year like people like to think. You know, I just happened a year later, the market boomed in that period of time, and I bought a $23,500 home that ended up selling less than a year and a half later for $38,500. And it's your own capital gain free area. I was able to utilise that money to buy a couple of small blocks of land and start building some small spec homes out west, which is where I ended up opening my first office. So it was an interesting process, just buying a block of land, getting a builder to build a house on it and selling it. No different than the pre-sales nowadays, only that the product was well underway and well under construction before I sold it. It wasn't a home, and I go back to it, that I wanted, wasn't my dream home, but it was a home I could afford and in an area where capital growth was somewhat guaranteed, and I think that's the critical thing.
So you lived in that place in Punchbowl?
I did,
first off?
Yeah.
For a year or so?
I did. Traditional home, you know, with the purple velour lounge and the shag pile carpet. It was lovely. And painted on wallpaper. That's how impressive it was. I painted on the wallpaper myself.
And how did you sort of identify Punchbowl as somewhere where you wanted to buy your first home, obviously sort of close to transport and all that sort of stuff?
Look, interesting enough, now yes, that was an important part of it, but interestingly enough, it was one of those locations that people probably didn't want to buy in. And nowadays, of course, it's a different story. But there are a lot of pockets around capital cities that people talk down. There are suburbs that people have negative comments to make about, whether that's because of government housing or whatever. And those are the areas, in my view, that have the most potential. And I look at them now. There's still people say to me, "Where do you buy?" And I say, "Look, if you're going to keep buying where everybody tells you to buy, you're going to be paying the highest possible price." And it was one of those areas that had the transport but didn't have the prestige.
So you sold that place, you bought some blocks of land out west. Whereabouts did you buy?
Out Penrith Way,
okay.
Cambridge Gardens, of all places. Yeah. It was an area there that I started selling real estate in, and so I saw the potential in it. And blocks of land were selling for $8,000 to $10,000 then, and we're talking back in the 70s, back in 76, because 77 I bought a real estate office. I was 21 years of age, and I really didn't know what I was doing, as I've said once before. But and disappointed my parents, who'd spent copious amounts of money educating me at boarding school, hoping I'd become a doctor or a lawyer. But nonetheless, I went out to those areas, and those areas nowadays, particularly out west of Sydney, or even in parts of other capital cities that were not seen as great areas, are really boom areas nowadays, and the price of properties secured. When you go out there, you know that you're going to do well, and this is an important part in terms of investing. People ask me where I should invest, and apart from the locations, you should invest in where people tell you to invest in, or where the hotspots are, you should avoid, not go to. Apart from that, I've always told people, if you're buying an investment property, buy it in the price range that, no matter where you are, that is at the top of the first home buyer's range and literally at the bottom of the second home buyer's price range. Because what that does for you when you do need to sell, it's about how many people you can expose your property to. If you have an unusual property, you're going to have 10 people looking at it. If you've got a property that's in the middle of a price range, you've got 100,000 people who are going to look at it. And so you've got a better chance to sell, and that's the safety part of it. And people move away from that safety part way too early in their investment career.
So Cambridge Gardens, you bought there, you built a couple of places, and then you purchased the real estate office in that same area.
Did,
so
you
really understood it, so it was on the high street in Penrith, was it originally?
Good on you. You know the high street Penrith.
I do. I know well.
229 High Street Penrith was my
go.
first real estate office, and it was a little bit out of town. And if you can imagine a kid in a dark suit with black hair and pimples on his face, which obviously is not there today, but it did present a bit of a concern when people would come in looking for the manager of the business. But nonetheless, that's where my first office started.
So Penrith in the 70s is a pretty hard town as well.
Very. You had a lot of English migrants coming in there, and they particularly like to purchase long industry homes. I'm not quite sure what it was, but it's almost as though where you get a community buys a certain style of home and their friends come over and visit, and then it rolls on from there. But it was one of those areas that was very farming, very much like northwest of Sydney now, very large chicken farms and whatever else out in those areas. And there's nothing there like that now, of course. You could literally go from a kilometre west of, or north or south of High Street, and it was farm. It was farmland, and now it's a thriving city. But I live in the Blue Mountains, interestingly enough, and that was an area that people never considered very much of. But today, if you were to buy a property in Glenbrook, first part of the Blue Mountains, you're paying almost twice as much as you might pay in some of the outlying suburbs of Penrith.
Interesting. Just completely off topic, but sort of connected. One of our best investment properties is in Cambridge Park. You know, we picked it up for 235,000.
I could have been the agent that sold it.
Yeah, no, this was like this was in 2013, 2012. We bought it, and the thing's doubled in value.
Okay.
Yeah.
Right.
Absolutely brilliant.
You still could have bought it off my company.
Could have done,
sure.
yeah.
Yes. We have an office in.
Might have actually.
Yes, we have an office in Cambridge Park, and perhaps I should check that we're managing that property for you. All right.
It's good. So living in the Penrith area, and you're a young bloke building a career in real estate. After those couple of properties that you bought for investment purposes in the Penrith area, what come next for you? How did you sort of start building a property investment portfolio?
It was an interesting process because, like most people, you want to buy an investment property that you like, and I made that mistake like most people did. And I purchased properties over a period of time that didn't really move to the direction I'd like them to have moved. Yeah, again, I got my rental return, but I didn't get my capital growth. And I remember watching other people doing the same thing, buying a one-bedroom apartment, for example, in Kingswood 30 years ago, and then 10 years later, you still couldn't get the price you purchased it for because the population growth hadn't moved out there. So things of that nature you've got to be very careful about. Just buying property for the sake of buying property is what everybody thinks is correct, and it's just so far from the truth. And a lot of people do make that mistake. Yeah, my property portfolio has changed quite considerably since I first started buying real estate.
So have you gone from like a couple of properties to many properties? It's obviously a journey which has taken a number of decades, but can you tell us a little bit about that process and how you've evolved?
It is a very big balance between residential, community title and commercial property. It is a big balance, and they're risky. Each one of them has their own risks. Commercial property is one that can be a devastating risk for some people, at the same time and a massive return. So each capital city that my company is in, I bought the strata, bought the floor, so that I don't have to move. And I remember just recently, I've got 2 floors in York Street in the city of Sydney, and I've just had an offer to sell one. But about a year ago, the agents said to me, we've got buyers for 3.1, 3.2. And I'd paid about 2.8 as an investment. But I was able to hold on to that investment because the rental return wasn't there. And if it was a normal investor, and that was the only way of getting cash flow, they would have been in trouble. But I sold it 12 months later for 4.1 million. And it gives you an idea of how quickly the market can change. It's not about small increments. It's about a supply and demand issue that comes and goes every so often. And I got luckily got caught up in the right time of that cycle to sell that floor. And so I think that that's the critical thing. If you're going to be an investor, you can be an investor in the bigger end of town if you want to be, but the risks are really quite massive if you're not careful. So the investments I've bought haven't been exactly great in the sense of what you might buy them for. I love buying older buildings. They're not great for... you can't knock them down, and I've got a lovely building in Lura, which I consider probably the best commercial building in Lura, and it houses a Cafe Bonton that's been there for 40 years, and I bought that building with the restaurant because the lady wouldn't sell them separately. Now, I'm not a restaurateur, but I love the building. Can I knock it down? No, it's heritage. The gardens are heritage, but it's got a great rental return. There's just something about that property, and the commercial growth of the Lura village is quite substantial. But if I really thought about it long and hard, maybe if I sold it and bought 4 investment properties in Penrith, I might have done better from a capital growth point of view.
True.
So, Charles, just going back to when you bought your first property, what have you how's your understanding of financing changed? And when you first went and bought that first property, did you understand the financing side of things as well as the property investment side of things?
And that's the hard part. Going back in the early part of the years, people talk about funding and all that right now. They have no idea how easy it is today in comparison.
Yeah. So what was the process? Did you go along to your local bank manager? What was the process?
It was either a bank manager or a lawyer.
Yep.
The lawyers were given allocations of loans, and if those allocations dried up, that was it. Unless you had a relationship, going back to that favourite word of mine, unless you had a relationship with a lawyer, your buyers didn't get an allocation.
Okay.
So you could actually have a buyer for an investment property, but they couldn't get the finance. And so it was very much a bank manager situation. You'd lob in, and a lot of people today use brokers because they don't want to go to the bank manager. They're scared of the bank manager. And this is why I think the brokerage industry has done so well. And I think financing then was so much harder. Interest rates were incredibly high. I got caught up in the 18% interest rate marketplace, 18-19% interest rate, and it's horrible. It's a horrible time. And I bought a home in the Blue Mountains before the interest rates started to go crazy. I paid $205,000 for my home in 1984, and everybody thought I was a nutcase because properties were selling for $50,000 in Penrith, just down the road. And then I got hit with the high interest rates, which is why I say today the interest rates are low enough for you not to be as concerned as we might have been when there were no real mechanisms in place in those days. APRA didn't have the influence they had. Reserve Bank structure wasn't the same as it is today. So people are watching it every 4 weeks, literally, to see what's going on.
So for you as a young buyer and somebody building a business, as well as actually securing the finance, it's obviously incumbent on you to balance and manage your cash flow. What did you learn along the way when building a multiple sort of property portfolio?
I've learned to be there when the boom happens, and this is what the biggest issue is. A lot of people weaken and look at the future, and they get a bit scared and they pull out and they walk away too early. My big thing is you've just got to be there. You've got to stay there. If you don't stay there, you're in trouble. If you have to get a second job or a third job, or if you have to change your lifestyle, you do that. Because you got in there for a reason. You just need to be there when the cycle changes, and that's where a lot of people fall away.
Yeah, it's good
and
advice.
You think about it, and you see so many people who listened to the bubble talk. If you go back a year ago when the gentleman out now, Harry Dent, is out again talking about the bubble. If you listened to Harry a year ago, if you listened to Harry 2 years ago, if you listened to Harry 3 years ago, 4 years ago, talking about the bubble, think about what you would have lost in capital appreciation if you'd have not paid any attention. There were people that sold their homes a year ago or 2 years ago because the bubble was coming, and look what happened to the marketplace. It went to the next level. And it didn't go above where it should. We keep talking about that, the fact that we had in a casual discussion that my daughter bought an apartment, and 10 years ago, she only settled on it 5-6 months ago. 10 years ago, it was $440 and she paid $860. That's not even double. Now, real estate's supposed to double every 7 to 10 years. We're in the right place we should be right now. And I think we should have steady growth from here on in.
So staying in the game is important. So
absolutely staying in the game. Can I give another property minor plug, if you don't mind.
Sure.
Well, I have an 18-hole championship golf course down at Kangaroo Valley. Actually, you might be talking about
Small
that, do you?
property.
What are you talking? No,
It's tight. I've actually played there, Alex. It's all right.
I
It's good
didn't
for
buy
hackers.
I didn't
Yeah.
buy the property initially because I understood golf courses. I bought the property because it was it was being sold through a commercial agent, and the bank had stepped in, and everybody had made it very clear that it was an issue. Nobody wanted to lend on it because the banks had lost money on it. Who wants to buy golf courses? Macquarie Bank, really championed that cause and then pulled away from it because of the difficulties associated with it. But it's a nice 18-hole golf course with little villas on it. I bought it because I can build villas and I can build an accommodation portfolio. It's cost me a lot of money. It's not the sort of investment that you go into thinking I'm going to make a fortune out of, because the people who did before me thought that, and they got into trouble. It's a long-term process, and here I am 17 years later after having purchased that property, and it's just starting to show the return that I needed it to show. So now it's got the potential, so I've just got to hang in there. You've got to have some way of hanging in if you want to make something happen.
Have you been on the verge of going, stuff it, I'm going to let it go over that last 17 years? Have there been any points where you've thought it's too much?
Unfortunately, Alex, I've become emotionally attached, and and so yes, I keep going down there thinking that my golf is going to improve because I own the property. The only way it's going to improve if I decide to change the par and make it 85 to 90.
Or if you play alongside Phil Tarrant, you'll look a lot better.
I'm not a very good golfer, as everyone knows.
Well, I like golf because they say that somebody gets joy out of every golf shot, especially when it's somebody else's bad shot.
So staying on the theme of staying in the game, so making sure that when you get into the market, you stay in the market, because then you can actually experience different ebbs and flows. Do you think property investors today, and I speak from experience and people I speak to, they think property investment means buying a big expensive property that they'd like to live in, rather than something which is an investment, which allows them to ride the market
It's
cycles?
the massive mistake that most investors make. They buy something they like. I got on a flight from the Gold Coast to Sydney maybe 10 years ago, and I was sitting next to a young couple who had a Century 21 logoed shirt on. And so they started asking me questions, and I said, "What are you doing here?" And they said, "Oh, we've just bought new properties." And we bought half a dozen, and I'm sort of looking at them, and I really frightened me, because they'd gone all the way away from their own patch, their own backyard, to buy property that was new and shiny, that was cheap to get into. And it concerns me that people buy investment properties the wrong way and then wonder what goes wrong. If you really are an investor and you want to buy a property, sometimes you've got to buy some properties in some very average areas, but just remember infrastructure is critical, and avoid hot suburbs that people are talking about. My advice is to buy in between those suburbs, because a lot of the time there's suburbs that people try to get a postcode. They want to live in a certain postcode, and they live on the edge of another postcode, so they always want to promote the postcode they live in rather than the one next door, and the one next door is the one where you get the best value.
So looking at your property portfolio today, and when you started in that property in Punchbowl, if you go back to then and you said to that Charles Tarby at that point in time, "Mate, don't do this, do this instead," what would that be?
If it was about capital growth and a mix of capital growth and rental return, the few properties out there are okay, because I'm the tenant, so I can look after myself. The golf course, well, I could have done so much better. With the millions of dollars I've invested in there, I would have been able to buy a significant number of properties in the Sydney market, as an example, and have fantastic capital growth. But I wouldn't own a golf course, and that's the hard part. The hard part is, what do you end up doing? And every so often I do look at it, Alex, and I think, what am I doing here? And then you stop and think, if I sold it, what would I do? I'd buy more property.
Yeah.
And would my lifestyle change? No. I live in the same house I bought in the Blue Mountains. I'm a real estate agent's nightmare. The one I bought 32 years ago, I still live in that same house, and I don't want to move. So would I do anything different? No. So I guess it's about the way you live more than what you have. And I think that's the important part of it. And if an investment property is going to cause you concern, you can't handle it, don't get into it.
So you've built a very successful business through Century 21, but you've got real estate running through your blood as well.
Yeah.
So in terms of your personal investing, is it always property first and then other stuff secondary? Or what's sort of like your whole sort of wealth portfolio look like? Is it more
they're
property or
both,
something
they're
else?
both connected. Really interesting because if real estate got me into business has helped me buy real estate and help me with cash flow. So they're very both strongly connected. Going outside of that into the stock market, I don't understand it enough. I'm not savvy when it comes to the equity markets, and I'd have to rely on somebody else, and that's always scared me. So it's the only time I don't have any control over my own destiny most of the time. Even if I got a first-class ticket and sat at the front of the plane, I'm still not flying it, and it still gives you that fear, doesn't it? So I think that at the end of the day, the two areas I've invested in are my business and in real estate, and kept it at that level at most times. And both at the same time, obviously, as I mentioned earlier, I'll buy a property I can rent off myself when it comes to a commercial sense. So I'm in both of those businesses at the same time.
Sound, and I completely agree with you. You know, me personally, I won't invest in stuff that I don't understand, and I don't have the time really to really immerse myself in the equities market to actually understand where to invest the most.
It's a long haul, Phil. It's a really long haul. A lot of people, you hear the great stories. You hear the stories about people who have land and it's become development land, and or developers who buy sites and they build them, and you see all these people driving around in fancy cars because they're developers. You know, the truth is nobody has it easy. Everybody's got to put in the same amount of time to make something work. You've got to really think it through. It's not about buying. If you buy an investment property development site and you make $1 million out of it overnight and you think you're a legend, let me tell you, it doesn't take long before you're brought back down to earth again. And the market changes so quickly, you've got to be on top of it. Unless you're prepared to take those massive risks, you really should buy within your means, buy an easy investment property, don't go over the top, and wait. You've got to be in there when the cycle occurs.
Charles, just a question with you, again, with your real estate hat on, and it's about market cycles changing quickly these days. So going back, excuse me, in even a couple of decades ago, a decade ago, figures didn't get dispersed so quickly. Now, because of the data that you've got, because of the immediacy of sentiment, do you think that this now, I mean, typically property markets would change slowly. You know, do you think now we're in a market where things can change much more quickly as a reaction to auction rates falling, or to just sort of general sort of commentary and sentiments?
It's what you hear about. We hear about a train crash in India, where 10 people were injured nowadays. That's what our world is like. And you start to become paralysed. If you listen, if you go on social media marketing today, you'll go from literally from a boom to bust and back to a boom again just within 3 or 4 different posts on Facebook. And it's incredibly difficult to make decisions. This is why I say to people that anything is possible when you don't know what you're doing. If you're too educated, you won't make a decision.
Yep.
And I think that a lot of people don't bite the bullet. You've got to be realistic about it. If you're in a strong capital city in one of the most safest regions in the world, where the weather, I mean, I notice that the English get a little arrogant during their 5 days of summer that they have. So the thing is that...
And that's an Indian summer as well.
If you're buying in an area and you're buying within your means, and if you are nervous, we don't always recommend fixed. I recommend fixed every now and then to a nervous investor. I think that you're pretty safe. And I just get a bit concerned with people who are trying to go too quickly with their investor. They want it to happen now, and it's not going to happen like that. You know, when I first started buying property at 18 years of age, and now I'm 61 years of age, I'm not thinking that, if I go back then, I wanted to have the $1 million by the time I was 30 sort of scenario. It doesn't change your life. I think if you get a nice lifestyle and a nice pattern, stay with it. The investments will work for you. They'll be out there. They'll do the right thing over a period of time, provided you don't go crazy with it.
Sound advice.
It is good. So we're going to wind up, Charles, and we'll get you again, mate. I really enjoy the chat, but if I was going to quickly summarise...
I'm enjoying the free coffee.
Yeah, it's good, isn't it? If I was going to summarise this quick chat, 3 things I'd say is it's time in the market, not time in the market. So do what you can to stay in it.
Yes.
Keep it simple. Don't overcomplicate your property investment by buying 10 off-the-plan apartments in wherever it is, just stuff that you can afford to hold. And have a bit of fun with it as well, I imagine.
I think so, and I think that's absolutely correct, Phil. Just be careful, because if you want, you can make a lot of money. You could just buy at the right time, and you could do fantastic stuff with 10 properties off the plan, but you could also devastate your entire life. And I think you've got to focus on what it's all about. Why are you doing this? And if it's, for me, it's about my family, my children. I've always focused on them. Every time I make a business decision, I wonder what it might impact on them, because at the end of the day, they're going to have to carry on what I've started and attach it to their own lifestyle. So why would I do anything to damage that? Just go crazy, and when I can just simply buy an investment property, I can sit on it for a while and I can just wait the cycle out.
It's good. And if you're down in Kangaroo Valley, 18 holes of the course, it's really good.
If you find out I'm there, if you tap me on the shoulder, I'll give you a free game of golf with a card. How's that sound?
There you go. All right. Alex, thanks for joining us.
Yeah,
mate.
Thanks, Phil.
Get you back again soon.
Yeah,
People
hope
like
so.
listening to you for some reason. I don't know why.
why.
But it must be that...
Token pom.
Yeah, something like that. Remember to check us out at smartpropertyinvestment.com.au, and thank you also to everyone for rating us so highly on the iTunes podcast. We're always tracking up the top there of business. If you've got any reviews or you want to have a chat with me or ask a question, editor at smartpropertyinvestment.com.au. You can also follow us all the Facebook stuff. Me personally at Philip Tarrant on Twitter. We'll see you guys again next week. Thank you. Bye.